Are you interested in peer-to-peer lending but know absolutely nothing about it? Do you think peer-to-peer lending is too risky? Do you want to get good returns on your peer-to-peer investment, but you don't want to spend ages looking through each individual loans? If that is the case, then Squirrel might be the option for you. In this video, I'll be doing a review on the peer-to-peer lending platform, Squirrel, also known as Squirrel Money. Squirrel is New Zealand's second largest peer-to-peer lending platform behind Harmoney, with over 1,000 borrowers and over $24 million in personal lending. Now, while they are the second biggest peer-to-peer lending platform, they are significantly smaller than Harmoney, which have lent out over 1 billion New Zealand dollars. I have a separate video doing a review on the Harmoney platform, so check that out if you haven't already. Today I'll be going over both borrowing and lending for the Squirrel Money platform, which includes the main features and how you would invest and the risks involved and what sort of protection that you get and the fees and also the pros and cons of the platform. Let's look at borrowing and loans first. So Squirrel originally started off as a mortgage broker back in 2008 with the peer-to-peer lending system, Squirrel Money, launching in 2015. Squirrel mainly focuses on personal loans, although they do offer some commercial loans as well. To sign up for a loan, you need to be over 18 years old, a New Zealand resident, have a good credit history, and a New Zealand driver's license or passport, and transaction history from your bank account. The commercial lending focuses on four main categories, which include working capital, purchasing a business, commercial property, and business insurance. On the other hand, for personal loans, the four main categories include personal lending, debt consolidation, vehicle loans, and homeowner's loan. After signing up for a loan, Squirrel will assess your details and assign you to a credit grade from A to E, with different interest rates for each. For a personal loan, you can borrow up to $20,000 over a 3 years period with a $250 establishment fee. For a debt consolidation loan, you can borrow up to $50,000 over 5 years with a $500 establishment fee. For a vehicle loan, you can borrow up to $70,000 up to 7 years with a $250 establishment fee. And for a homeowner's loan, so this is a loan if you want to make improvements around the house or buy new furniture, you can borrow up to $70,000 over 7 years with $0 establishment fee. Now let's have a look at the lending aspect for Squirrel Money. One of the great things about Squirrel Money is that it is funded by retail investors, which are just basic individuals rather than big institutions such as banks, like other lending platforms such as Harmoney and Lending Crowd. This is partly why when you see a new loan listing on Harmoney or Lending Crowd, it quickly gets gobbled up immediately. Squirrel advertises an average investor return of 8.6% per annum, but in reality, the figure is probably more close to 7.5% for a 5 to 7 year loan investment. Now let's take a look at how to actually invest in a loan in the Squirrel interface. Investing in Squirrel peer-to-peer is extremely easy. Simply pick the length of term that you want to invest in and the amount that you want to invest. There are 3 different lengths of term you can invest in. There is the 1 year at fixed 6% return, and 2 to 3 years at 6.5% to 7.5% return, and 5 to 7 years at 7.5% return to 8.5% return. An important thing to note here is that the minimum investment amount is $500, which is much higher than the $25 for Harmony and $50 for Lending Crowd. For the 2 to 3 year and 5 to 7 year term period, you need to place a bid at the percentage return that you are looking for. Squirrel will then automatically match your bid to new loans that come up. The lowest return bids will get matched first before high return bids. For example, your bid at 7.5% will get matched before someone else's bid at 8% return. Due to the massive amount of lenders available, I have personally found that there is no point in bidding anything other than at the lowest return rate. For 2 to 3 years, it's 6.5%, and for 5 to 7 years is 7.5%. You can set up an auto bid in exactly the same way as you set up a one-off bid order.
Ultimately, this means that you are more likely to get less returns with Squirrel Money compared to Harmony and Lending Crowd, where you can get more than 10% returns. And unlike Harmony and Lending Crowd, you don't actually get to see where your money is going or any details about the people borrowing the money to make you decide whether to invest in a particular loan or not. So far it's not looking particularly good for Squirrel Money. You have to invest more upfront and make a less return. So what's its saving grace? Let's take a look at how Squirrel manages risk. So Squirrel does not use fractional lending, unlike the other two main peer-to-peer platforms. Instead, they offer a loan shield reserve fund to protect against the defaults. Every time a borrower repays their loans, a percentage of it goes towards the loan shield fund. If a borrower is late on their repayment or a loan defaults, the reserve fund is automatically activated to pay out to the investors. For a high-risk grade D loan, a higher percentage of the borrower payment will go towards the loan reserve fund compared to a grade A loan. This means that investors don't need to worry about the loan grade of each individual loan because the risk across all of the loans get averaged out. This is very different from Harmony and Lending Crowd, where you basically decide the amount of risk that you are willing to take when you invest in a particular loan. The current reserve levy sits at around 2.47% across all the different grade loans, while the estimated default rate is around 1.12%. Which means that you would require a 5% plus of default rate to use up all the reserve fund. While not impossible, this is quite unlikely to happen unless there's some major economic downturn. In the unlikely event that all the reserve fund does get used up, Squirrel can direct all interest payments towards replenishing the reserve fund to make sure that investors don't lose their principal. Another great feature offered by Squirrel is the secondary market, where you can take out the money invested in a loan by selling your investment to other investors. Squirrel charges a 1% fee of the loan being transferred up to a maximum of $50 per investment. As of making of this video, they are the only peer-to-peer lending platform in New Zealand that offers this particular service. And it's really fantastic because your money doesn't need to get locked away for multiple years if you require to use it straight away. However, this feature is reliant on there being other investors that's available to purchase your investment. But at the moment, there is a large surplus of investors, so this should not be a problem. Let's have a look at the breakdown of the fees. For the borrower, there is an establishment fee ranging from $0 to $500, depending on the types of loan that you apply for. A default fee, default interest, and dishonor fee may be charged if you are late on your payments, and a security release fee if you have security held against the loan. For the lender, there is a service margin of up to 3%, depending on the grade of the loan, and a reserve levy, which goes to fund the Loan Shield Reserve Fund. There is also a 1% fee up to $50 per investment if you choose to sell your investment on the secondary market. The great thing is that the service margin and reserve levy gets automatically taken out, so you are basically getting the returns that you picked when you set up the investment. So now let's look at the pros and cons for Squirrel Money. So for the pros, it is funded by retail investors and not financial institutions. You can take out funds early by selling your investment on the secondary market. You also don't need to spend as much time looking through each individual loan. And they have a loan shield to protect against loan defaults. For the cons of Squirrel Money, you get lower returns than Harmony and Lending Crowd. There are many investors and not as many borrowers, which means that you could be waiting for days or weeks before you get matched to an investment. This means that you also don't get any interest on the money sitting around in your loan account. You can't see any borrower details, so you don't really know where your money is going. And finally, there is quite a high minimum investment amount of $500. So Squirrel is one of the newest entry to my portfolio. And in my experience, I find Squirrel extremely easy to use, and I don't need to spend ages looking through all the loan listings like I have to do on Harmony and Lending Crowd. By having a loan shield, it also solves the problem on other peer-to-peer lending platforms that many people only want to invest in high-risk loans that give off higher interests. The secondary market is fantastic if you need to access your money in a hurry, and I really wish that more peer-to-peer platforms would have that feature. They also have a mobile app if you would like to check your balance on the go. You can look at Squirrel Money as the easier, lower risk and lower reward peer-to-peer lending platform compared to Harmony and Lending Crowd. While Squirrel might not be for everyone, it's quite good for people that want a more simplistic approach to peer-to-peer lending. Check out my other videos on reviews on investing platforms in New Zealand, and I will see you in the next video.